Regional banks on the rise today following the $66 billion merger of BB&T and SunTrust, the biggest bank merger in a decade. Bob Pisani is at the NYSE with all the details. Hi, Bob.
Hello, Melissa. You know, the good news is this. M&A may finally be picking up in the banks. Here's the bad news. The premium offered for this merger is pretty small, and there's a good reason for that. Growth is really tough to come by in the crowded banking industry. So we have low rates. They're making it difficult to grow interest income. We have loan growth that's also been very modest, even with a strong economy. Here's a final problem. The banks have been struggling for deposit growth, partly because the Fed has been shrinking its balance sheet. You know, remember, these banks, they're on the other side of that balance sheet equation. So the banks are also facing enormous costs associated with going digital. The cost of moving to digital platforms is enormous. But once you make the investment, the good news is it's all scalable. So those who can get bigger and who can offer more differentiated products are going to win out. Those who are not will offer generic products with very little competitive advantage. They're going to be takeover targets. That's why M&A makes sense for these banks. You have to spend to scale up the technology to go digital, but once you have scale, you can be more efficient and then you can cut costs. In the case of BB&T and SunTrust, it helps, by the way, that there's a significant footprint overlap. Both are very heavily concentrated in the Mid-Atlantic and the Southeast regions. That makes it easier to get that synergy. The hope for M&A activity is one reason the largest regional banks have outperformed this year. The regional bank ETF is up 17% this year, but the financial ETF is only up half of that. Why? Well, another factor in regional bank outperformance is the financial ETF also includes broker-dealers and asset managers. They're all engaged in massive fee wars. They've got problems of their own, as well as insurance companies. They're also underperforming this year. Back to you, Melissa.
Great breakdown. Thank you, Bob. Bob Pisani at the NYSE. So let's trade this. We did see, as Bob had mentioned, a big ramp in these banks. In today's session, though, there are some banks that really stood out. Comerica, MTB, those banks are up more than 3% each.
Because I think what the market is saying, maybe I'm off base here, but I think the market is saying, you know what, this is the first of now many deals that have to happen. Well, what does U.S. Bancorp have to do, if anything, PNC? There are a number of banks that maybe get forced to make a move. Maybe they don't want to make. But I think this was the largest bank deal since 07, 08. Is that right? Mm-hmm. That was an interesting time, if you recall what happened in a year and a half after. I'm wondering, my question would be, did deals like this happen at the beginning of something big or towards
the late cycle? Or
towards more of the late cycle?
When there's nothing left to bring out.
Well, look, it's no secret that net interest margins, NIMs for these banks have been getting squeezed tight. So scale matters, and these are probably the two highest quality players in the regional banking universe. So to imply that this is and I don't think you're doing this, Guy. It's an interesting question to ask. I do think that banks right now are going through a painful period of also, you've seen major inefficiencies from the overall market been taken away from them, where they were able to price people. In other words, technology means they can't take the same amount of people. So bottom line, Citizens Financial, Huntington Bank shares, I think those are ones that are going to go higher.
Plus, it has a lot to do with that $250 billion asset cap. So these two banks would have been there in 3 years on their own with the growth that they have now. So people want to, or banks want to, stay below the Fed's radar because you have that 250 wide berth on assets. That's why they merged, because together they would have gotten there in a short amount of time as well.
All right. Our next guest says there are two buying opportunities in the bank sector. Two. Let's go off the charts with Todd Gordon of tradinganalysis.com. Hey, Todd.
Hey, Melissa. Let's take a look, as Bob was mentioning, on KRE, the regional banks versus XLF, the larger financials. There is outperformance, as he mentioned. You could see that right here. Relative performance of KRE to XLF. As this line is moving up, that means regionals are outperforming financials. However, financials as a whole are underperforming the broader market. We're seeing the 210 yield curve, yield spread, up around 18, 19 basis points. It kind of double topped up around 22, 23. So we're seeing a little bit of a flattening of that 210 spread, which is going to continue to pressure the financials. That being said, here, as we take a look at the KRE, this purple line right here is the 200-day MA. We are below that. The broader market, different sectors are testing the 200-day. So again, we have underperformance in the banks. That being said, we might be able to trace a little bit of an inverse head and shoulders here. If there is going to be a little bit of a retest and we do push up, that would be great. Up around the 52, 53 mark in KRE would be constructive, but there's a lot of wood to chop above. That being said, I do own a bank in my portfolio. I own Bank of America. It's best in breed in XLF. Same concept with Bank of America to XLF. Look at the ratio. Basically, bank divided into XLF. As this line is going up, bank is outperforming the financials. Same thing, 200-day, smack dab into it. We've been hanging around there for a while. We've backed off a little bit here in Bank of America. If we can hold some support and, again, chop through that 200-day, constructive. I own Bank of America. If we don't hold lower levels, which I'll show you on this next chart, that's all right, we're going to just talk about it. Right around the 26, 27 mark, there's a gap in Bank of America. If we close that gap and don't find a bid, I'm going to bail. As I said, financials are underperforming. A regional bank that's showing really, really good relative strength here is Zion. Same kind of idea here with the ratio of KRE via ZION. Zion is outperforming the regionals. We're coming up on that 200-day. If we can break above the 52 mark, get up through that, buy stops are going to go off, and I think you might get a momentum play up in Zion. So that's best in breed of the regionals, which are outperforming financials.
You know, Todd, in Bob Pisani's outline of the financial sector overall, the XLF, he mentioned insurance companies underperforming, all the different components sort of adding to this underperformance. Which subsector do you see as the weakest, or which one is
within the financials?
Yeah, within XLF overall.
Sure. I mean, broker dealers, I think, Goldman is weighing on them significantly. As I said, as a whole, financials are really underperforming. I would certainly look, if the market does roll over, I'm more of a short-term trader rather than a longer-term portfolio investor. I certainly would look to some of those weaker sectors. If we do get that roll-off back below 2,700 in the S&P, I would look to be short some of those asset managers, some of the investment banks, Morgan, Goldman, insurance, as you mentioned. But regionals are strong, so I'd stay away from the short side there.
All right, Todd, thank you. Todd Gordon of tradinganalysis.com. Todd mentioned Bank of America. I looked over to Dan because I know you.
Well, you know, I actually think he makes a great point about the investment banks, about Goldman Sachs and Morgan Stanley. This is the year that Uber, all these guys are going public. This is Morgan and Goldman's bread and butter, supposedly, right? And these stocks really underperform the broad market. I do not like the bounce off the lows in those names. So to me, I suspect you're going to see something very similar to what we saw in 2018. They really led to the downside. They were the tell for a good part of the year.
So first of all, banks have totally outperformed. Citibank is outperformed the S&P by almost 1,400 basis points. That's not a reason to go buy Citibank right now. In fact, I would actually go buy J.P. Morgan relative to Citibank. J.P. Morgan has drastically underperformed the high beta money center banks, and it's the best of breed by far. If we're going through a choppy period, J.P. Morgan will outperform, and again, it's up 6% year to date with a balance sheet to me that is far and away best in breed.
You know, you mentioned Zion, so let's talk about that quickly. I mean, it's been in a pretty well-defined downtrend, but that stock has gone from 38 or so to 50 in a straight line over the last probably 2 weeks, 2.5 weeks. So I'm more inclined to sort of fade that move here than to try to buy the breakout. I think there'll be an opportunity to buy it again, but I think the opportunity will be lower.
Do you think Zion Williamson is going to be playing for the Knicks next year?
You know, I have a slogan for. Oh, sorry.
It's just like you say, anything that comes into your head. You realize we're on live TV?
Absolute children.
I forgot about that.
Anyway.